The ultra rich have been hiding a massive secret from you that is just now starting to get exposed. They've been leveraging this strategy for decades to build and preserve wealth, and people are just now starting to uncover it. But the reality is, they haven't actually even been hiding it from you. You've been hiding it from yourself because you've been too skeptical to believe it could possibly be real. But don't worry, in today's video, I'm going to break down exactly how it works in plain English so you can do it too. You've just got to promise me you're not going to look at me like I'm crazy until the end, which by then I guarantee you're going to want to know how to do this too. Allow me to introduce and define to you the concept of becoming your own bank, or what we also call today infinite banking. And it's true. Wealthy people today, they don't need to waste time going to an actual physical bank to borrow out money because they have mastered the concept of becoming their own bank. And no, people, I don't mean that they're going out there and opening up an actual brick and mortar location with their name on it, like Bank Oriba, although that would be pretty cool. It's more of a metaphorical bank, and it's built on the back of life insurance. Okay, wait, don't look cross-eyed at me just yet. Allow me to explain. First, we need to understand what life insurance even is. It's basically a sum of money that you purchase on your life to pay out to your beneficiaries when you pass away. We all know it's going to happen. We just don't know when or how. Now, there are two different kinds of life insurance. There is term insurance and there is permanent insurance. Term insurance, think temporary, like you're renting or leasing a car. It's only good for a certain amount of time, maybe 10, 15, 20, 25, 30, all the way up to actually 40 years now. And you get access to a large amount of life insurance for a much smaller cost per month because it's going to expire at some point. There's no fancy additional components to it. It's basically you own it, you die during the amount of time it's in force, it pays out to your beneficiaries, all tax-free. Permanent life insurance, on the other hand, think of it like you're owning a house or you own a car. You have it forever, right? Permanent life insurance does not expire, and that feature alone makes it more expensive than term insurance because you don't ever have to worry about it disappearing. But there are two very important components that are a part of permanent life insurance you need to understand. First, component number one is the actual death benefit. This is the amount of insurance coverage you are purchasing on your life that will pay out to your family when you pass away. The second component is the cash value component. All permanent life insurance policies have the ability to grow this cash value component inside the policy, which was really originally created just to sustain the death benefit. It doesn't technically get owned by you, it's really owned by the company. But depending on how you set up your policy, when you pass away, that cash value can get added to the death benefit, and all of that pays out to your beneficiaries tax-free. Now, the cash value component to these insurance contracts is crucial. This is the component that we use to become our own bank. So you need to understand now how you can access money out of your cash value. And you can do it in one of two ways. First is a withdrawal. You usually want to avoid this at all costs because if you withdraw any of your interest, it's going to make your interest taxable, which kind of defeats the entire purpose. The second way you can access money is in the form of a loan. Loans are the unique feature that we get inside of these insurance contracts that you see pretty much unmatched really anywhere else at this level. And it's the ability to actually borrow out your own money, but you're doing it in a way where you are not interrupting compound interest, and it allows you to access all of your money in your cash account 100% tax-free because loans are not considered taxable income by the IRS. Think, last time you took out a loan to pay for college or to buy a car, to buy a house, did you get taxed on that as ordinary income? No, because loans are not considered income. They are considered a loan. But in order for it to be considered a loan, the IRS requires that the insurance companies charge you an interest rate to borrow it. So they do that. They might charge you somewhere between 4 to 5% interest to borrow out your money, but what you're actually doing is borrowing from the insurance company. They're using your money in your cash value account as collateral for the loan to basically say you're good for it. And that's what allows your money to still grow and earn interest like it never left. And then if you were to just randomly pass away with an outstanding loan, they'll just deduct that amount from the cash value that's left, and that cash value would get added to your death benefit, pay out to your family 100% tax-free. The key here is the policy actually has to be structured correctly if you're actually trying to borrow money out of the policy relatively pretty early in the contract, which is really what people are trying to do when it comes to infinite banking. How you structure your policy is crucial. This is where most life insurance agents and policies fail. because these policies have to be set up correctly from the beginning in order for them to act as an actual bank. It's crucial because the death benefit controls everything. The more life insurance you get inside your permanent life insurance policy, the more money you can stuff into it per year to grow cash value. The less life insurance or the smaller the death benefit, the less money you can put in. Now, if your goal is to grow cash value, we've got to keep the cost of the policy down and make it as low as possible so that your cash can grow quick. And the only way we can do that is by getting you the least amount of life insurance required for the most amount of money you want to contribute per month or per year. That is going to keep the cost down and ultimately help your cash grow quicker. Another key to these is you don't ever want to accidentally overfund the policy, because if you ever overfund it, you are now going to create what's called a MEC, a modified endowment contract, which just basically means all the interest you're earning inside your policy is now taxable, which defeats the whole purpose. So we want to avoid that, but most insurance companies won't even let you create a MEC, so it's not really a huge concern. Okay, now that you understand all the working components of this strategy, you know you want a permanent life insurance policy because it grows cash value that you can borrow against at any time, at any age, without any penalty, without paying any taxes. And you know that you need the least amount of life insurance required for the most amount of money that you want to contribute per month or per year, because that's going to help your cash grow quickest. Now you're probably wondering, well, how are wealthy people using this to become their own bank? Well, wealthy individuals are putting a lot of money into these plans on a monthly or an annual basis. Usually on an annual basis, you might see lump sums of maybe $50,000, $100,000, $200,000 or more going into these insurance policies every single year with the intent to borrow back out a portion of that to maybe start a business, maybe invest in some commercial or some residential real estate, maybe go and invest in another asset. They use it for all different sorts of things. And when they borrow that money out, they are not interrupting their compound interest. Their policy is still growing and compounding like that money never left because of the loan features that are available inside these plans. So infinite banking is essentially the ability to leverage money in two places at one time. And the best part is this can really be done at any income level. While the infinite banking strategy might be best suited for people that are on the wealthier side putting in larger sums of money, this strategy can work for anybody at any income level. You just might have less money to take out if you're putting less money in. Now, if you're left there thinking, this sounds too good to be true, it's not, because there is an approval process to even owning these plans. Because of the fact there is a life insurance component, the insurance companies will take a look at you. They're going to look into your age, your health history, and your criminal background. And that's going to determine whether or not you can even get approved to own one of these products and essentially become your own bank. But in my opinion, I think infinite banking is a fantastic strategy to implement if you can get approved. If you'd like to learn more, I have linked 2 videos here that will tell you more about how it works. Make sure you subscribe so you don't miss another video on unique financial strategies like this. Drop a comment below, let me know what you liked and learned, and I'll catch you next week on YouTube.